The other stock in focus is BEML. The company has reported a good set of earnings for Q4. Their margin has expanded, the profit has expanded 65%, while the EBITDA has also seen a good growth. Their order book, though, has missed the FY24 guidance of 14,000 crores. So we have Shantanu Roy, who's the chairman and managing director of BEML, who's joining into this discussion now. Shantanu, thanks a lot for joining in. It was a good Q4. The revenues just about making it to double digits, and EBITDA growth was about 29%. Can you tell us this 24.5% EBITDA margins, right? Is it something that is sustainable in FY25? And is that something that you can build on to? Are there any triggers for a better operational performance in FY25?
Well, very good morning, and thank you very much for having me here. The EBITDA margin, the EBITDA growth that I had already mentioned in my earlier chats, that it will be a growth of around 200 basis points. So we have achieved the promised numbers. But yes, I won't say that this is going to happen every year, because again, we are in a capital goods industry. We are in an engineering company in manufacturing. So an EBITDA of 14 to 15% is quite healthy, I would say. So I don't see a similar EBITDA happening year after year, but yes, we will definitely improve upon the EBITDA margin by at least 100 basis points in the current financial year.
You're saying that the EBITDA margins at 24.5%, you're saying that in the current financial year, you will be sustainable above 25%, right? Fair enough? 100 basis points higher is what you're looking at.
Well, what I meant was that the yearly EBITDA, the overall EBITDA margin for the year 23-24, we have managed to keep it around 12%. A growth of around 200 basis points as compared to the last year's EBITDA, which was 9.9%.
Okay.
The guidance that I have in my mind is a further growth of around 100 basis points over this 12% EBITDA annually.
So, okay. So 13%, right, Mr. Roy?
Yeah.
Okay.
It should be,
all right.
should be around 13%, which I feel is fairly, which should be fairly good.
No, absolutely. And good morning, Prashant here, and congratulations for a strong set. And you've certainly revitalized the company, and there is a sense of excitement with results, and of course, investors are looking forward to what you can do further. What about sort of top-line growth? What should we expect in 25?
Top-line growth, I will maintain it at around 18 to 20% CAGR for 24-25, as well as the coming years as well. Yes, we just barely managed the top-line growth of around 4% in the last year, but there were certain reasons for that. And one of the major reasons was the challenge on the supply chain, challenge on the material, which was beyond our control because of various geopolitical happenings. But in spite of that, we managed to have a growth. We managed to have a improved bottom line with a focus on maximizing the shareholder return, the stakeholder return. And I'm very happy to share that for the first time in the history of BML, we have announced a dividend of 205%. It has always been around 100%. So that is a major positive from the last financial year. Apart from, of course, the growth in EBITDA, and of course, the diversification and further consolidation and restructuring of the company that we have undertaken, and which is going to pay dividends in the coming years.
All right. Hi, good morning, Mr. Roy, and good to see you. And as always, congratulations to you as well as the entire team. I believe that BML has completed 60 years over the weekend. So good going, and wish you all the best. Now, we've got a couple of details out of the way. 18 to 20% revenue growth, margins at around 13% odd. Break it up for us sectorally. How much of growth do you see coming in from the railways, defense and mining? And what could be the rough revenue mix for FY25?
Good morning, Nigel. Thank you very much. Yes, it is indeed a very momentous and joyous occasion for us on completing 60 years of the existence of BML. The 60th year foundation day celebrations were a mega event. And before I move on to the guidance for 24-25 sector-wise. Let me talk about the numbers, the contribution sector-wise in the 23-24 numbers. So we have seen a huge spurt in the contribution of rail metro vertical to the top line. Last year, it contributed 27% to the top line. This year, rail and metro has contributed 38%. Mining has gone down to around 43% from the 50%, which is going to be the scenario in the next in the coming few years as well. However, the major challenge came in the defense vertical, wherein even though we had the orders, but because of execution challenges, defense could contribute only around 19% to the top line of the company. For 24-25, again, my guidance will be mining, defense and rail and metro should put together contribute around 60%. The number is around 57% put together for both of them in 23-24. It will go up to at least 60%. Mining should be around 40%. And that is going to be the trend. I believe somewhere along the line, during the coming years, we will be having a contribution of around 65% from defense and rail and metro, and mining will stabilize at around 35%. Of course, the volumes will also go on increasing. The total numbers that we have planned for the top line, they will also go on increasing in absolute terms.
Okay, got it. Now, given that we are in an election year, do you see some headwinds on the order inflows? What can you guide for FY25 in terms of order inflows? And if you could break it up for us sectorally. At the end of the year, what kind of an order inflow number should it be looking like?
I was expecting this because Sonia had earlier mentioned that we missed the guidance of 14,000 crore. So I don't know whether it's because of the election year or not, but yes, there was some more tenders which were deferred, especially in the metro and the rail sector, where around 3,000 crores of orders were deferred, which will now happen sometime between June and September. So that was one of the reasons we missed the guidance of 14,000 crore. For the year 24-25, as I mentioned the last time, the opportunity size for defense in our core capabilities is around 6,000 crore. For the rail and metro put together, it's around 58,000 crore. And mining, the opportunity size that we can see at present is around 3,000 crore. So that will be the opportunity size for us. And the order book guidance, well, if we have a hit rate of 50% for the rail and metro and for defense aerospace, and if we can have a hit rate of 80% for the mining, anything between 20,000 to 30,000 crore to end the year with will be a decent number for us.
This MOU that you signed with BEL, right, to develop this indigenous train control systems, can you tell us a little bit about it? What is the kind of timeline that you're looking at? What is the key rationale behind this? What can it contribute to your business?
The TCMS, or the Train Control Management System, is one of the backbone for any unmanned train operation. It has a onboard hardware as well as it has a software part. And it's a part of the propulsion, and along with the propulsion, it basically controls the train movement. Wherein a direct communication is set up between the train, the signaling, and the central command center. India has a very typical requirement for a metro, where the TCMS is a dual homing system. In all the metro tenders, the future is all grade of automation 4. And there is no Indian TCMS which is available at present. We are dependent on the foreign OEMs who generally keep TCMS as a part of the propulsion. So it is one of the major steps towards Make in India and Atmanirbharta in metro automation that we entered into this MOU with Bharat Electronics for developing a TCMS which will serve the country for the future years in grade of automation 4, achieving grade of automation 4. And the timeline that we have in mind is somewhere between 12 to 18 months.
Oh, so 12 to 18 months for this MOU. So can you quantify it for us, this TCMS opportunity? What could it mean? I'm sure you haven't factored it into your guidance right now, correct? Or just correct me if I'm wrong. What kind of monetary opportunity do you see because of this?
Well, the guidance that I have just given, it also has TCMS, but it will not
Okay.
be the indigenous TCMS. The indigenous TCMS, when it comes into play, because it is, once we develop, it has to undergo validation, it has to undergo extensive trials. So the entire thing may take, that's why I said 12 months to 18 months. Once it is done, then of course, every year we see a growth in the metro. So if we annualize, the annual metro rolling stock guidance is around, I'll put it at around 2,000 to 2,500 crores. That is the average. And that is the kind of opportunity size that we can see in the future. Not only this, in the commuter rail, also we have a TCMS. We can further tweak the TCMS for the metro, which is much more stringent to the commuter rail segment as well.
Okay. So 2,000 to 2,500 crores of an opportunity is what you said, right? Annually, I assume.
It is the rolling stock opportunity. TCMS is
The
a part
rolling
of
stock
it.
opportunity.
It is
Okay, okay,
very
got that.
integral and important and critical part of the rolling stock.
Got it. Any other opportunities from the government's end? I mean, what kind of impetus are we seeing from the government on spending both on rail infra and defense capex? What is the incremental opportunity that you see for a company like BEML?
You see, the opportunity size is huge, as I mentioned. Rail, it is not only the various rail-borne maintenance vehicles or the rail grinding machines, basically the track machines, but also the Vande Bharat passenger trains and the semi-high-speed trains. So the opportunity size is huge. As far as defense is concerned, our focus is very much on the engine and the power pack. And apart from the engine and power pack, we are also focusing on the combat vehicles, on the combat engineering vehicles, which is the future requirement of the Indian Armed Forces, along with the mainline combat vehicles for the Indian Armed Forces. We also have taken a route of diversification, and in our endeavor for diversification, we have just set up a strategic business unit of aerospace, wherein we see a huge growth in the coming years. And apart from the aerospace, we have two micro SBUs, which will be under the aerospace. And one of them is the maritime. The maritime and naval systems presents a huge opportunity to a company like BEML. And it is one of our main focus diversification areas. As far as the investments are concerned, we have already undertaken a path of investments, of capital investments. This year, we have planned a capex, which is around roughly around 8 to 9% of our last year's revenue numbers. And this is mainly focused towards enhancing our defense manufacturing capabilities, our engine manufacturing capabilities, and our rolling stock manufacturing capabilities.
All right, just want to clear the air, sir. On the order book, currently it's 12,000 crores. You said you'll end the year at what?
I said somewhere between 20,000 to 30,000 crores.
20,000. That's a broad range, but we'll hold you at that number, 20 to 30,000. Maybe as the year progresses, we can narrow down on that number. And finally, have you heard anything with regard to progress on the divestment of the company?
That's one of the most difficult questions, that you always put across, Nigel.
But we want to know about it, sir. If there is any kind of movement, have you heard something?
No, we have not heard, and Deepam is the right agency to answer that question, Nigel. My job is to ensure that the company remains on the path of growth, and we grow at a CAGR of 18 to 20%, and we keep on giving more dividend to our stakeholders.
Okay, we'll hold you at that, Mr. Roy. Always good seeing you in. A revenue growth of 18 to 20%, margins at around 13%, order book by the end of the year at around 20 to around 30,000 crores. Wish you all the best for the remainder of this year, and we'll keep chatting with you as the year does progress.
Thank you very much.